Our next speaker is going to address that issue along with many others related to crop insurance. Nick Paulson joined the University of Illinois Ag Econ faculty in the fall of 2007. He serves as an assistant professor in agricultural and consumer economics with research focusing on risk management, including crop insurance, as well as ethanol and biodiesel. But as a member of the Farm Doc team, Nick contributes a lot to the policy section regarding to changes in agricultural policy, risk management, with a focus on the ACRE program from both your side of the vantage point as a participant in ACRE and as a sort of federal policy perspectives. Nick is a Minnesota farm boy. His dad still farms there up to some 3,000 acres. And so with that, please welcome Nick Paulson.
All right, thanks, Stu, for that introduction. As Stu said, I'm from a farm in southern Minnesota, and 2012 was a pretty good year for us. We took advantage of the high prices, and we had yields that weren't quite as affected by the drought. But I went and overeducated myself at Iowa State, and then, as Stu said, started here in 2007. But I still call home to make sure my dad can tell me whether or not what I do makes any sense. So in classic academic fashion, I've included about 90 minutes worth of slides for my 30-minute presentation. But I'll try to kind of go through those quickly. The major points that I want to make, we'll look at just real quickly, just an overview of the crop insurance program. And I do want to say just a few things about performance historically, and then look at some estimates for what we think performance in the program was for 2012. And then I'm going to get into some rating changes for 2013 and some things to think about as you make insurance decisions over the next 2 weeks. In terms of those rating changes, there's kind of two big changes to the program that are kind of being put in place over last year and then also being phased in 2013 in terms of changing the rates that you pay for insurance, and then also the trend adjustment, which for those of you who purchased crop insurance last year, you may be familiar with, which is affecting what you can guarantee on the yield side when you make some of those insurance decisions. Something we probably won't have time for, but I did include some slides, and happy to, if you want to contact me or talk to me after the presentation. And also, not a big factor if we don't get to it this morning because the Farm Bill was extended, so nothing will really matter here for 2013. But some changes in the Farm Bill related to crop insurance and how they interact with commodity programs and how that might be something you need to think about for crop insurance and commodity program decisions. Potentially as early as 2014. So I think one question that some of you may have is what types of products will be available this year. I did say there's been some major changes to the program, but these are not major changes that affect the types of insurance policies that you can purchase relative to maybe what you looked at last year. The acronyms changed last year from what they used to be, but yield and revenue insurance programs are going to be available just like they were for the 2012 crop insurance year. So revenue protection, that's farm-level revenue insurance that includes the adjustment in the guarantee if we see futures prices increase relative to what the base price that we've set here in February. Revenue protection with the harvest price exclusion, meaning the price component of the guarantee stays fixed at what this springtime price is. And then the other most popular product in Illinois is the GRIP with the harvest price protection option, the county level revenue program, again, which does include that increase in the guarantee if prices do move up from the springtime level to that final harvest futures price. So revenue protection and GRIP HP are by far the most popular. About 80% of the acres in Illinois are insured for both corn and soybeans, and by and large, most farmers elect one of those two programs at a fairly high coverage level, 80 or 85% or even 90% for GRIP. I'm going to put a disclaimer on this. These are prices These are the prices that we would have if the determination period had ended yesterday. These things could move by a few cents, especially if we had a big move today. I haven't looked at what the markets are doing today, but about a $5.65 base price for corn, which is slightly lower than the $5.68 price that we had for 2012. The volatility factor, which is going to impact, the higher the volatility factor, the more uncertainty about the price, the larger premiums, the larger crop insurance rates will be at any coverage level. That's around 20%, again, through yesterday. That's a little bit lower than it was last year. The combination of those two effects for corn means for the same policy, same coverage level, your insurance premium will be slightly lower in 2013 for corn than it would be in 2012, just based on these price and volatility effects. Soybeans, the base price is a little higher than the $12.55. Again, this could change based on what the market does today, but right now, through yesterday, about $12.87 on soybeans, 17% volatility. That volatility is a little bit lower, so the net effect on premiums is probably about kind of a wash. So soybean premiums you can expect to be pretty similar to what they were last year. Wheat, 8.46 and 15.5% again through yesterday. I did want to put this right at front because I'm sure a lot of you are interested in this. Some of the examples I'm going to go through have different prices because they were put together last week or earlier in February when we did have quite a bit of movement, especially from the first week in February through the second and third week in February for corn. So some of the prices I use in the examples are different than these, but these are what they would be if the determination had ended at market close yesterday. So just a few points on trends, and again, I think you have these slides, or maybe even more slides than I have in the presentation today that Stu provided in the handouts. Crop insurance is a huge program, and I heard you talk a little bit about this with Congressman Davis during the lunch keynote. About $12 billion in premium this year, more than $100 billion in liability. This crop insurance program now is significantly larger even than the whole suite of commodity programs that we have. So direct, counter-cyclical, acre, and the Sure Disaster Assistance Program. As I said, some fairly major changes phased in last year and this year in terms of how the program is rated, which determines what you pay in premium for crop insurance. And that's the way that RMA rates, the way that they determine what crop insurance costs is they look at historical performance. Again, the changes are based on what we've seen in historical performance since the last time rating had a fairly major overhaul. A lot of the work that's been done that's led to some of these major changes was funded by the National and Illinois Corn Growers Association. And again, there is kind of two major things going on concurrently here being phased in over the 2 years. So a change in the rates that we'll look at, as well as the introduction of the trend adjustment option that you have for determining your APH yield. Again, just looking at the program over time, if we look at the number of acres insured, corn, soybeans, and wheat are the three largest crops, whether you look at acreage, premium, liability, and they really dwarf everything else. The next one, the next largest crop in terms of premium or acres would be cotton, but you could basically combine wheat, cotton, and all other crops, and they still wouldn't be as big as corn and soybeans in terms of premium and liability in the program. We've seen a consistent increase in the number of acres insured. As I said earlier, about 80% of acres in Illinois are insured at some level, usually with a revenue policy at a pretty high coverage level. Across the country, 275, 280 million acres insured. So that's between 80 and 90% participation in terms of acres having some form of insurance coverage on them. If we look at premium shares, again, corn really almost dwarfs everything, and when you combine corn, soybeans, and wheat, that really is the crop insurance program in terms of the amount of money spent, the amount of resources allocated. About 40% of the premium in the entire program comes from corn policies. And if you add these three together, these account for between 75 and 80% of the program. So all other crops, including cotton, rice, horticultural crops, specialty crops, they're only about 20% of the program. These three crops are about 80% of the program. All right, I'm going to show you some maps here and some information. I'm going to kind of consistently refer to the loss ratio, so I just wanted to define what that was. So the loss ratio in insurance lingo takes the ratio of insurance payments that are made during any given time period, these would be the indemnity payments that you'd receive, to the total premium collected. So a loss ratio of 1 implies that the insurance company was collecting exactly enough to cover the losses that were paid out during that time period. What the crop insurance program has is a long-term goal, a long-term target of a loss ratio just equal to 1. Okay, so over time we want to set premium rates so that we collect just enough in total premium, not producer-paid premium, but in total premium to cover the losses from the program over time. All right, if we take a look at the performance of that then, just from 2002 to 2011, and if we want to just focus briefly here on this total, collected about $64, $65 billion in gross premium over this 10-year period. Paid out about $48, $49 billion in indemnities. So there have been net gains, which are split between the insurance companies and the government, of about $15.5 billion. Over time, about 11.3 of that has gone back to the companies as underwriting gains. About $4.1 billion in underwriting gains back to the government. This does not reflect the subsidy that the government also puts in, or the A&O reimbursements that the government also provides the insurance companies for helping administer this program. This is purely the underwriting gains, looking at indemnities relative to the premium dollars that have been collected. And that $15 billion number is kind of important. Does anybody know why? That's kind of the estimate for where we think losses are for 2012. Okay, so over the last 10 years, the gains are about what we think were losses for the 2012 crop year. Claims are still being processed, but that's kind of where at least Gary Schnicke and Bruce Sherrick are estimating losses for across the entire program, all crops, all states, for the 2012 year. Now, again, one of the reasons motivating some of these rate changes that I'm going to talk about, adjustments in the rates that you pay for insurance, are driven by the fact, historically, if you look at performance, there's pretty significant differences in performance across crops. Basically, what this table tells you, if you look at the loss ratio column on the right-hand side, over time, going back to 1995, corn has paid in, corn premiums, every dollar of corn premium that's been paid in has resulted in 60 cents of indemnity payment coming back to farmers. About 64 cents in indemnity coming back for every dollar paid in for soybeans. Okay, so more money's been collected in premiums than has been paid out. Some of the other crops have actually received more in indemnity payments than they've paid in historically. Cotton, well, sunflowers has a 1.3 loss ratio, but cotton here is has the largest loss ratio of kind of the major crops in the insurance program. But basically what this says is that corn and soybeans, Midwestern crops, have kind of cross-subsidized some of the losses experienced in crops that are grown outside of the Midwest. All right, you can see that geographical pattern if you look at these loss ratios mapped across the country. Okay, so the areas in green, which captures most of the Midwest, are loss ratios below 1, meaning more in premium has been collected than has been paid out in indemnities since 1995. Whereas the areas in red, okay, southern states, southeast, south central part of the country, cotton, rice growing regions, more indemnity payments have been paid out to farmers than has been collected in total premium. Loss ratio is greater than 1. Okay. Again, the long-run target is for the program to have a loss ratio of 1 over time, but they also don't want certain crops being treated differently or better than other crops. So seeing these geographical differences is one of the motivations for adjustments to the insurance rates that we started to see phased in last year and will continue to be phased in for 2013. All right, so just a quick summary on some of those points. RMA, it's kind of an ongoing effort to adjust rates to reflect historical performance, again, with that loss ratio of 1 being kind of the long-term target. One point I do want to make that I can come back to maybe later if we have time. There's been a lot of concern over whether the 2012 crop year, whether there would be enough money to make payments. There is no risk of insolvency to the program. There is enough in reserves to be able to cover 2012 losses. And again, over time, you can expect to see continued changes to rates to adjust to that historical performance with that long-term target where total indemnity should equal total premium over time. The other point, I guess, that I made here is that 2012 is not going to mean crop insurance is going to be more expensive in 2013. It won't even mean crop insurance will be more expensive necessarily in 2014. Okay, the way the rating works is the large losses in 2012, that is information that will be incorporated, but it's not going to have as big an effect as you might think in terms of we need to charge more for crop insurance because of what happened in 2012. As I said, again, because of what you see in this picture, adjustments to rates, crop insurance rates were started to be phased in last year. So from 2011 to 2012, all the areas in green here, so most counties within Illinois, a lot of the other Midwestern counties, we saw crop insurance rates come down from 2012 to 2011. That doesn't mean you paid a smaller premium, because insurance prices and your APH yield affect your premium, but the rate for crop insurance in general came down throughout most of the Midwest. Changes from this year compared to last year, you're going to see a similar pattern. Another round of rate reductions, at least throughout most of central and northern Illinois. Again, this doesn't necessarily mean that your premium will be lower for the same policy. It means that the rate for that premium will be lower because of the adjustments that our ARMA is making over this 2 or 3 year period. All right, so that's one thing that's going on in crop insurance. The other thing that I mentioned is the availability of the trend adjustment for your APH yields. This is one of the biggest program changes ever. And it's very complicated how this actually works. I've heard Bruce Sherrick explain how the APH trend adjustment works, and I don't understand it. But basically what this means is that yields have increased over time. The trend adjustment option in crop insurance allows you to have that reflected in your APH yield. So if you're using a 10-year yield history, that yield from 10 years ago is going to be adjusted up because of that trend effect. That's going to tend to increase your APH guarantee, whether you're looking at corn or soybeans. Okay, how much is that yield adjusted up? Well, the trend rates for 2013, if we look at Illinois here, most of central and northern Illinois is in the largest two trend adjustment categories in this map, the darkest green and the second darkest green here. That means that your trend adjustment is between 1.5 and 2 bushels per year, basically. So a yield from 10 years ago would be increased by 20 bushels, 15 to 20 bushels, as that is used to calculate your APH guarantee, okay, for corn. For soybeans, the trend throughout central and northern Illinois is between 0.3 and 0.4 bushels. So again, if you got a 10-year-old soybean yield that's being used to calculate your APH, that would be adjusted by 3 to 4 bushels based on this trend adjustment to put it on a current year basis in calculating your APH yield. Okay, so again, the effect of this trend adjustment is to increase your farm's APH yield to account for the fact that yields have increased over time, and those old yields in your yield history should be adjusted so that they're on a present-day basis. Again, without really needing to understand the process by which those trend rates were determined, it is important to understand the effect of the trend adjustment. Okay, so in this table here, just a quick example in terms of how premiums would be affected by this. So if you're comparing an 85% policy to an 85% policy, your premium is going to be higher if you do the trend adjustment relative to if you don't do the trend adjustment. But you have to think about that with that 85% protection, you're guaranteeing a larger revenue if you use trend adjustment than you are if you don't use trend adjustment. So a fairer comparison is really between 85% coverage without trend adjustment and 80% coverage with trend adjustment. Okay? And the reason for that is your effective yield protection without trend adjustment at 85% is about 151 bushels in this example. That's the same yield trigger to generate an indemnity payment. You're still protected for yields below 151 bushels at 80% coverage if you take the trend adjustment. Okay, so your coverage is the same even though you've elected a lower coverage level. And if you compare the premiums here, this is a $22.80 premium versus a $15.26 premium in Macon County. So you're actually getting equivalent coverage at a lower price. That's because subsidy rates are higher at lower coverage levels and just the way that the rates work as you move across the coverage levels. Okay, so it's important to think about that, the coverage that you're getting when you start thinking about whether or not to take the trend adjustment. All right, summary on that. Those of us at the university can think of no reason why anyone in Illinois would not take the trend adjustment. Again, given the trend rates, what it does, given what premium rates are in Illinois, it doesn't matter if you're in Macon County, Southern Illinois, Northern Illinois. The trend adjustment is a good option to take. There was lower participation last year than was anticipated, but we think that'll probably come up in 2013. And again, this is kind of the other big factor in the ongoing, or the other big piece of the continued changes to the crop insurance program that started to begin to be phased in last year. All right, 2012 losses. I'm going to show you a few estimates here in the next few slides that Gary Schnittke put together in mid-January. These numbers have changed as more claims have been processed, but just focus on the general picture here. The states in red have a loss ratio here. These would be for corn policies across all the different combo products, so yield protection, revenue protection products. Illinois' loss ratio, we were estimating at about 3.22 for corn in mid-January. That's come up to over 4 now with the additional claims that have been processed throughout February and the end of January. Missouri was the other. Missouri and Kentucky were the other 2 states with the very high ratios for the corn program. But this really reflects where the drought had the biggest impact. And corn was by far the crop impacted the greatest in terms of yields by the drought this year. All right, if we want to take a look at loss ratio estimates across crops, again, corn, if you average over all states, so again, in Illinois, it's around a 4 loss ratio right now, but average across all states, about 1.75. Soybeans had a loss ratio below 1. Soybeans weren't nearly as negatively impacted by the drought as corn was. And if we take a look at the states across all crops, so not accounting just for corn, but taking a look at all crops, Illinois is leading the way here in terms of losses with a loss ratio of above 2. Missouri and Kentucky are also in that large loss ratio category across all crops. But if you look at the national, it's still pretty close to that 1 target. So again, even though losses are very large in Illinois, and very large on corn in Illinois, corn in Missouri, corn in Kentucky, overall, the loss ratio of the program isn't too far away from that long-term target. So just thinking about corn in the Midwest overstates the negative performance of the program as a whole for 2012. In terms of what this looks like across the state, again, these are January estimates, but the state average is around 4. Larger losses throughout central and southern Illinois. Losses were not quite as severe in the northern part of the state. All right, so summary on the 2012 program. Underwriting losses are going to be pretty large. In January, Gary was quoting a range of 10 to 20 billion, which I realize seems like kind of a large range to quote, but I think we can narrow that down to 15 or 16 billion now in terms of total indemnity payments. Again, those payments don't have to be authorized in terms of how the program works. But in looking forward to the future, the large cost of the insurance program this year that there will be probably some political issues, some negative publicity that comes out of that. And again, the crop insurance companies, even though losses are large this year, they're paying out more than they took in. They have enough reserves, and they do share in those losses with the government. So these are updated estimates I got just this week. Overall loss ratio about 1.33. So again, a $12 billion premium. If the loss ratio is 1.33, that's where we get that $15 billion in total losses across all crops, all regions for the program this year. Much larger for corn in Illinois, Indiana, Iowa, Nebraska. Soybeans, better performance. Soybeans didn't do too well in Nebraska. But again, overall for the program as a whole, paying out about 33% more than was taken in premium. All right, as I said, because of performance in 2012, again, we don't have to worry about indemnities being able to be paid based on 2012 losses. It will not affect rates in 2013, will not have a large effect on rates longer term either. But again, it could provide political fodder to attack the risk subsidies in the program, the A&O reimbursements that the companies get, and then again, how the government shares in those underwriting gains and losses with the companies. So these are all things that 2012 performance, again, could be used against the crop insurance program. All right, so for 2013, again, the trend adjustment was available last year, will again be available this year. We'd suggest there's very, very few cases we could think of in Illinois where a producer would not be better off taking the trend adjustment. And again, premiums will not be higher this year because of the drought. Your premium could be higher for any other number of reasons. Okay, you may elect a higher coverage level. The crop insurance price is different than it was last year. Your APH yield is different than it was last year. But your premium will not be higher because of the 2012 drought. All right, so back to that first kind of big program change, the rate adjustment. Not the trend adjustment, but the general adjustment in crop insurance rates. In general, we should see a reduction in rates relative to last year. So not considering how the crop insurance prices change, not considering how the volatility factor compares to last year, but just looking at the rate itself, we should see those come down, or we will see those come down again in 2013. That means that if the insurance price was $5.68 like it was last year, if the volatility factor was 22% for corn like it was last year, your crop insurance premium would be slightly lower in most Illinois counties than it was last year if you buy the same exact policy. All right, just real quickly, some numbers here. Again, these premium levels are based on on the 568 price that we had last year and the 22% volatility factor that we had last year. Those are going to be different for 2013, although very close to those levels for corn. But this shows you what the producer paid premium would be in 2012 relative to 2013. If you compare at the same coverage level, same unit structure, you'd see that those 2013 premiums would be lower. Okay, again, this is just the rate reduction effect being illustrated here. Same thing for soybeans. Again, if the soybean insurance price in 2013 was $12.55, if the volatility factor was 18%, you'd see your 2013 premiums come down relative to the level they were last year, just based on that rate reduction effect. All right. In percentage terms, it's a pretty large effect, especially on soybeans, and the effect is larger at the lower coverage levels and the individual unit structures relative to enterprise units, but anywhere from about a 2% reduction in premium relative to last year up to over a 20% reduction at some of the lower coverage levels for basic and optional and even enterprise units for soybeans. Okay, so that's purely the effect of rates being reduced as part of one of those major program changes that RMA is implementing. All right. The other thing to keep in mind, though, is the effect of the price and the volatility factor. Okay, again, the base price for corn looks like it'll be a few cents lower this year. That will tend to reduce premium relative to last year, holding everything else constant. The volatility factor for corn also looks like it's going to be lower. That would again reduce premium costs, dollar per acre premium cost relative to last year, holding everything else constant. Soybeans, a slightly higher base price is what we're looking at. That would tend to increase premium cost. Slightly lower volatility, that's going to have an effect to lower premium costs in terms of dollars per acre. Okay, so there's these at least three different factors competing here between the base price relative to last year, the volatility factor relative to last year, and then the effect of the rate adjustments that RMA is putting in place. All right, here's something that just an example for Central Illinois. So a farm with an APH yield for corn of 178 bushels per acre might have a trend-adjusted APH yield if they took the trend adjustment, something closer to 189 bushels, 53 and 56 for their soybean APH yields. Again, put these examples together earlier in the month using a 590 price, which is above what we think it will be, and a 1320 price for soybeans, which is also above what we think it'll be. We got base guarantees based on an 80% coverage level, both with and without the trend adjustment, so $840 per acre. Without trend, $892 per acre with trend. And then the yield levels, actual yield levels at which a payment would be triggered if prices didn't change for those options as well. So with trend adjustment, you're getting effectively higher yield protection than without. Again, based on what we know through yesterday, the prices used here are about 4% too high relative to what we think the actual base prices will be. All right, a few illustrations here from the iFarm calculator on the FarmDoc website, so you can take a look at, regardless, you can take a look at from whatever county you're from. You can compare different coverage levels, different insurance policies for corn, soybeans, wheat, whatever you want to look at. And this will run through what the estimated premium cost will be. This will be updated with the final base prices and volatilities by next week. Okay, so a tool that you can use online to look at what your premium cost will be. Again, these numbers, if you want to review them in your handout later, these numbers are based on a 590 corn price. We think the corn price will be closer to 565. So these premiums would be a little high relative to what they would actually be based on that lower base price. Just another illustration here for soybean premiums, for revenue protection with and without the trend adjustment. At the various coverage levels you can elect. Again, these premiums reported here would be a little high because they're based on a 1320 soybean price relative to the 1278 or whatever I said we think the base soybean price will be for 2013. All right, the next two slides just compare what payments might look like for different yield and price scenarios. So if you took revenue protection, I guess the key thing to just keep in mind here when you compare this slide to the next one is that if the price goes down relative to the base price, revenue protection and revenue protection with the harvest price exclusion are the same insurance policies. Okay, you still get coverage at the base price, but if prices increase, that's going to increase your coverage with the revenue protection policy. Your indemnity payments at $6 or $7 corn are going to be higher than your indemnity payments would be at $6 or $7 corn with the harvest price exclusion. Okay, so just another thing to keep in mind when you're comparing policy options. All right, I think I'm gonna end on this slide, Stu, because I'm probably already over time. But Stu did ask me to include something on break-even prices at the recent Outlook Forum. I believe these were long-term projections for corn and soybean prices, so maybe not prices we can expect to receive in 2013, but longer term, looking at a $4.80 corn price and a $10.50 bean price. If we take a look at, if we use Gary Schnicke's budget numbers for Central Illinois, and we take a look at kind of the three main crop rotations that we have, so corn after beans, corn after corn, and soybeans, yields of 195 bushels, 185 for corn after corn, 56 bushels on beans. Look at the non-land costs of $510 per acre, $525 per acre, and $308 per acre on those three different rotations. And then we take a look at what break-even prices are at different cash rent levels, things start to get a little scary, especially if you're in that $400 to $500 cash rent range. So 480 corn is all right even at $350 rent, but gets to be a lot closer to break even once you get over that $400 rent level. On soybeans, it's tough to make even $350 cash rent, and growing soybeans to make much sense given where we are putting production costs, or where we're budgeting production costs for 2013. So just another point to keep in mind as you're negotiating rents coming up this fall. Like I said, the last few slides, I'm happy to answer any questions you might have related to Farm Bill and crop insurance stuff. But you can review those slides after today, and I'd be happy to take any questions. You can contact me here. The last slide has my contact information. Ask me any questions you want. If you want answers, you might want to contact Bruce Sherrick or Gary Schnicke on crop insurance, but you can ask me any questions you want. So.
Any quick question for Nick, by chance?
Yeah, that's a good point. The question was, will your 2012 yield affect? Will it affect your APH yield moving forward? Yes. Now there are some cases in Illinois where yields were so poor. There's a limit to how much it can affect it. There's transitional yields, plug yields that you can use. If you had an extremely bad yield year in 2012, there is a minimum yield that you can plug into that APH history. So, if you got 20, 30 bushels per acre, that will negatively impact your APH yield. The longer the series that you're using in that APH calculation, the smaller effect 2012 will have, but it will negatively impact your APH guarantee going forward.